Welcome to Arena Finance, the voice of personal finance. I'm Rudy Banerjee and I'm here with my colleague IP. This is part 3 of our series on investments. In this session, we will discuss mutual funds and exchange traded funds or ETFs. Here are the topics we will cover today. Number 1, Introduction to mutual funds. Number 2, benefits and risks of investing in mutual funds. Number 3, types of mutual funds. Number 4, differences between the various types of funds. Number 5, classes of mutual funds. And number 6, introduction to exchange traded funds or ETFs.
Most of you invest in mutual funds through your retirement funds. What are they? A mutual fund is a company that pulls money from many investors and invests the money in securities such as stocks, bonds, commodities, and short term debt. Essentially, they are a basket of securities. If you are new to the markets or unsure of which stock to buy, you can choose a mutual fund. A thing to note is that the mutual funds can also be volatile since they are a mix of securities like stocks, bonds, or others. The top 3 mutual fund companies in the US by the amount of assets managed are BlackRock with 10 trillion, Vanguard, and Charles Schwab with around 8 trillion each. A benchmark is a collection of stocks or other instruments that serve as a baseline indicator for measuring a mutual fund's performance. For example, the S&P index is a collection of 500 of the largest and well-known companies in the US. Your mutual fund will be benchmarked versus an index like the S&P index. You can also choose to invest in an index fund. What is NAV? Net asset value, or NAV, is the market value of that mutual fund that is determined by subtracting its liabilities from its assets. The per share NAV is then obtained by dividing the NAV by the number of shares outstanding in that specific fund.
Mutual funds offer several benefits such as number 1, diversification of risk. Without having to select individual stocks or bonds, you reduce the risk of your investment. This helps you to be safer with your money because if one of these securities does badly, you still have different securities to make money from. This makes your overall investment more diversified, secure, and profitable in the long term. Number 2, mutual funds are managed by experienced professionals. This makes investing easier for busy or inexperienced individuals, as they don't have to worry about making investment decisions or analyzing market trends. Number 3, liquidity. You can easily buy or sell mutual funds on any day that the stock market is open. As a result, they are known as liquid investments, and this flexibility allows investors to quickly access their money when they need it. On the flip side, here are some of the disadvantages of mutual funds. Number 1, fees. Mutual funds have extra fees and costs like management and sales charges. These impact performance as the amount of money you earn over a long period of time is reduced. We will discuss these in more detail later. Number 2, lack of control. When you invest in mutual funds, you give the authority to the fund managers. They make investment decisions and could differ from your own personal investment preferences. Number 3, market risks. By investing in mutual funds, you are subject to market risks similar to investing in individual stocks. For example, if the market goes lower, the prices or NAV of the mutual funds also goes lower. Number 4, tax implications. Even though you reduce your market risk, you still have to pay taxes. When you sell shares of a mutual fund, you'll owe taxes on that realized gain. But you may also owe taxes if the fund realizes a gain by selling a security for more than the original purchase price, even if you haven't sold any shares. This is something that is out of your control.
There are several types of mutual funds. Here are the main ones. Number 1, equity funds. They invest in a basket of stocks and aim for high returns. The number of stocks and sectors are determined by the portfolio manager. These are suitable for investors with long-term focus and high risk tolerance. Number 2, target date funds. These funds are geared toward retirement investments. They are a type of asset allocation mutual funds where the combination of securities and asset classes, equities, and fixed income shifts as your target date for needing the money draws near. If your retirement date is closer, the portfolio shifts more towards bonds and lesser stocks in order to reduce your portfolio risk and increase your income. For example, Vanguard 2060, the target date, which is 36 years away, has 11% of its investments in bond funds and the rest in equities. The bond allocation will increase as the date approaches. Number 3, balance funds. These funds are a combination of equities and debt instruments that are meant to provide growth while minimizing risk. These are meant for investors seeking safety, income, and moderate growth. The Fidelity Balance Fund (FBALX) has a combination of domestic and international equities, bonds, and cash. The equities have a 60% allocation, while bonds have only 36%. This suggests that the portfolio managers are expecting equity funds to outperform bonds. Number 4, fixed income funds. Fixed income funds invest in debt instruments only, government bonds, corporate bonds, etc. They provide regular income and stability for conservative investors seeking steady income. For example, the BlackRock iShares US Aggregate Bonds Index Fund invests in US government bonds, AAA, AA, and other grades of bonds in varying percentages. Number 5, index funds. These are funds that own all the stocks that are part of a specific index and attempt to mimic their performance. For example, an S&P 500 index fund would own all 500 of the stocks that are part of the S&P index in the same proportion or ratio. These are suitable for investors who are happy with market returns and do not attempt to outperform the market. Index funds involve passive investing using a long-term strategy without actively picking securities or timing the market. An example would be Vanguard S&P Index Fund that tracks the performance of the S&P 500 index. Number 6, money market funds. They invest in short-term debt securities such as US Treasury bills and commercial paper. The goal is to maintain a highly stable net asset value of $1, which is achieved by investing in liquid investments while paying income to investors in the form of dividends. These mutual funds are available from the top mutual fund companies like Vanguard, BlackRock, Charles Schwab, Fidelity, etc.
Many of you would have heard about open and closed end funds. Here is the difference. Open ended funds are flexible and you can buy or sell at any time. New shares are issued constantly. They are priced once daily at the end of trading at the NAV, and you may have to wait for your buy or sell order to fill and not get the same price you saw when you executed the transaction. There is also no maturity period for it. Example of an open-ended fund is the Vanguard 500 Index Fund. In contrast, a closed-end fund is more restrictive and issues only a specific number of shares. It trades on exchanges based on market supply and demand. Why do people invest in them? It is because it could generate potentially higher returns than open-end funds because of the criteria just mentioned. Example of a closed-end fund is the BlackRock Income Trust, symbol BKT. Here are the common types of equity and bond funds. Under bond funds, here are the categories. A. Domestic large cap. These funds invest in the stocks of US companies whose market capitalization value is more than $10 billion. For example, they would invest in Apple stock, whose market cap is $3.6 trillion. B. Domestic mid cap. These funds invest in the stocks of companies whose market capitalization value is more than $2 billion but less than $10 billion. For example, Box has a market cap of $4 billion and is categorized as a mid cap stock. C. Domestic small cap. These funds invest in the stocks of US companies whose market cap value is more than $240 million but less than $2 billion. An example of a small cap stock is SolarEdge Technology, symbol SETG, with a market cap of 1.7 billion. D. There is another category, microcap, but is not as common. These funds invest in the stocks of companies whose market capitalization value is less than $250 million. For example, Magna Chip Semiconductor with a market cap of $200 million. E. International mutual funds. These are funds that invest in foreign markets, excluding United States, and can include debt or equity investments. They work similarly to other mutual funds, with the fund manager pooling money from investors and investing in the foreign markets.
There are four categories of equity mutual funds. Number one, index funds. We have already discussed this. Number two, growth funds. A growth equity fund is a type of mutual fund that invests in companies that have the potential to grow faster than the market and earn high returns. They are often made up of growth stocks, which are more expensive and riskier than value stocks, and are typically well suited for investors who are willing to take on more risk and have a long term investment plan. Growth stocks tend to outperform during economic expansions and bull markets, but underperform when the economy slows. Examples of growth stocks are Nvidia, Tesla. Number three, value funds. These are funds that focus on stocks of companies that are perceived to be undervalued by the market. Undervalued means that the stock is trading lower than its peers by certain metrics. One of the most common metrics is the price to earnings ratio or PE ratio, which is their share price divided by their earnings per share. A high PE ratio can mean that a stock's price is high relative to earnings and possibly overvalued, and vice versa. A negative price to earnings ratio means a company is losing money or has negative earnings. These are stocks to avoid as they are amongst the first ones to go lower when the market goes down. Value funds are suitable for investors who are looking for long term growth as they are speculating that eventually this company will trade relative to its peers. Some other metrics used by value investors are price to book ratio, debt to equity ratio, and price earnings to growth ratio to discover undervalued stocks. Number 4, a blended mutual fund. It's a type of equity mutual fund that invests in both growth and value stocks to create a diversified portfolio. The strategy of a blend fund is to take advantage of the potential capital gains of growth stocks and the dividend income and stability of value stock.
A bond index fund is a type of bond fund that tracks a basket of or collection of bonds to try to attempt to match that specific index's returns. It is a way to measure the value of a part of the bond market and can be defined by specific characteristics like maturity or credit rating. Each of these bond fund categories are benchmarked to the specific index and their performance are measured relative to it. There are specific index funds for those as well that are offered by mutual fund companies. Here are the various types of bond funds. Number one, government bond funds. They invest in US Treasury bonds of different durations based on their particular strategy. Number two, municipal or muni funds comprise of a combination of bonds issued by different states, counties, cities, agencies, and local districts to finance capital and infrastructure projects. Number three, corporate bond funds. These are funds that concentrate on a diversified portfolio of investment grade bonds of various ratings issued by corporations which tend to have more credit risk than government or muni bonds. Number four, international bond fund. They invest in debt issued by a foreign government or company. For example, a US based international bond fund might invest in UK government bonds, Chinese corporate bonds, and other government and corporate bonds issued in foreign countries. Number 5, inflation protected bond fund. Their strategy is to invest in Treasury inflation protected securities or TIPS. TIPS are securities whose principal and interest payments are adjusted for inflation or consumer price index changes. They are generally seen as a wealth protection tool. Number 6, high yield bond fund. These invest in lower quality or low grade bonds, which are riskier than those of higher quality companies. These funds generally offer higher yields than other types of bond funds, but they are also more vulnerable to economic and credit risk. For example, the Vanguard High Yield Corporate Bond Fund invests 85% of its assets in bonds that are rated BB and below.
Now we'll discuss the differences between large cap, mid cap, and small cap funds other than the market cap and why you should have a balanced portfolio of all three sectors. Number one, large cap funds have low risk compared with other categories, are more stable, and have outperformed the market as of July 2024. As you can see, year to date, large cap funds have returned 15% versus 6% for mid cap and 4% for small cap funds. Number two, mid cap mutual funds have moderate risk and comprise of companies with growth potential and which are aiming to increase their market share. An example of mid-cap fund is the T. Rowe Price Mid-Cap Growth Fund symbol RPMGX. Number 3. Small-cap mutual funds have high risk and comprise of companies with high growth potential and agility. Example of a small-cap fund is the Vanguard Explorer Fund symbol VEXPX. It would appear that large cap funds are outperforming and will continue to do so, but it's not the case. This is due to two factors. Number one, investors tend to have recency bias, and number two, past performance is not an indicator of future performance. For example, between 1975 and 1983, small cap stocks measured by the Russell 2000 index outperformed large cap stocks 35.3% per year versus 15.7% per year. This is the reason why investors need to have a balanced portfolio of large cap, mid cap, and small cap funds. There will be periods of time when one outperforms the other.
In this section, we will discuss the various classes of mutual funds and fees. While mutual funds make saving and investing simple and affordable, these benefits and services have a cost attached to them. The fees that you pay help cover the costs of managing the fund's portfolio of securities, generating account statements, providing computerized account services, record keeping, legal services, printing, and mailing. Some fees also compensate an investment professional for his or her services, especially for the advice he or she provides in helping you select a fund to meet your investment goals. When you buy mutual funds through a brokerage like E-Trade or Charles Schwab, you pay a brokerage or transaction fee. This transaction fee can range from $14.95 to $49.95 or even higher. This fee is charged to provide you access to mutual funds that are not part of the fund family. A fund family is a group of investment funds that are managed by the same brokerage or investment company. For example, the Vanguard S&P fund is part of the Vanguard fund family. If you do purchase a mutual fund that is direct to the fund family, the transaction cost is free of charge. External funds to a fund platform are categorized as no transaction fee or NTF and transaction fee or TF funds. These fees can range from $20 to $100 depending on the brokerage. For example, on the Vanguard fund platform, Vanguard.com, if you buy a Fidelity fund or a Charles Schwab fund, in most cases, the transaction fee of $20 will be charged. So, one should check whether a fee will be charged when one purchases the security. When you pull up the fund description, it'll give you this information under expenses and fees. We are here to provide more information if you need help on this. There are three different classes of shares that you need to be aware of. Number one, Class A shares. When you buy Class A shares, you are required to pay an upfront fee, load, or front end sales charge when you purchase shares. This fee can range from 3% to 5%, but may be higher depending on the fund. For example, on a 10,000 investment, a 5% load would equal $500, making the value of your initial investment $9,500. Number two, Class B shares. With Class B shares, you pay a contingent deferred sales charge or CDSC on the back end, or when you sell your shares in the fund. The percentage may vary according to the mutual fund. Number three, Class C shares. These are shares issued by funds that don't impose a sales charge unless you sell too soon after your purchase, which is usually a period of a year. Instead, they charge an ongoing annual fee. C shares are probably best for short term investors with the investment time horizon of 1 year to 3 years.
What is 12B-1 fees? 12B-1 fees are annual marketing and distribution fees that mutual funds charge investors to cover the cost of selling and marketing fund shares. It is usually 0.25% to 0.75% of the fund's net assets. Class B shares charge 12B-1 fees, whereas Class A and C charge little or none of this. What is an exchange traded fund or ETF? An exchange traded fund or ETF is a basket of securities you buy or sell through a brokerage firm on a stock exchange. If you are trying to get exposure to a certain sector or index, ETFs can help in potentially lowering your portfolio risk while helping to diversify your portfolio. Examples of ETFs are number one, SPDR S&P 500, symbol SPY, which is the S&P 500 index. Number two, iShares Russell 2000, symbol IWM, which is the Russell 2000 small cap index. When you think about ETFs, think about mutual funds that you can buy and sell on the exchange.
Here are the differences between mutual funds and ETFs. When you buy mutual funds, you buy at the net asset value at the end of the day. Whereas with ETFs, you buy shares in the stock exchange. When you buy mutual funds, you have to buy a minimum amount, typically $500 and above, while in an ETF, you can buy just one share. Some of the other differences are shown. Here is an example. Vanguard 500 Index Fund symbol VFIAX versus Vanguard S&P 500 ETF symbol VOO. The holdings of these funds are absolutely the same. The top three holdings are Microsoft, symbol MSFT, Nvidia, symbol NVDA, and Apple, symbol AAPL. The minimum for the index fund is $3,000, while the ETF has a recent price of $506.81 per share as of July 19, 2024. So, which one should you buy? You should buy an ETF if you want to trade it short term, whereas if you want to hold it long term, then the mutual fund is preferable. Thanks for joining us today. In the next session, we will discuss real estate, commodities, and precious metal investments in detail. Feel free to leave your questions in the comment section below. We are here to help and answer any inquiries you may have. And please don't forget to follow us on YouTube, Facebook, Twitter, Instagram, and TikTok.